All right, so today's speaker is Alex Perney. He's with Advanta IRA. He's going to talk about using your IRA to invest in real estate. Alex is the host of Advanta IRA's renowned podcast, The Alternative Investment Advantage. Alex brings a wealth of knowledge and insight to the table. With his esteemed designation as a certified IRA specialist, Alex is a trailblazer in navigating the intricacies of self-directed IRAs, employer plans, and IRS regulations. For over a decade, Alex has been at the forefront of empowering investors to diversify their portfolios beyond traditional assets, from precious metals to real estate syndications, private stock offerings to promissory notes. Alex has guided thousands of clients towards alternative investments with remarkable success. I distinctly remember the first time I heard Alex give a presentation about 9 years ago. I remember thinking, this doesn't apply to me. Fast forward to today, I regularly use my IRA and other people's IRAs as foundational pillars to invest in real estate. Let's give it up for Alex Perney.
Thank you, John. To make that a little bit more succinct, I'm a tax nerd. The government gives us a playbook on how not to pay them, so why not read it, right? It's that kind of easy to think about. Granted, the tax code is anything but simple to navigate, and that's why we are doing what we're doing. So, just a little show of hands in here. Is everyone at least familiar or heard of a 401k? All right, most people, you at least tangentially familiar with what an IRA is, kind of the individual version of that. Okay, great. Because remember, just because you're starting out, even if you don't know, I'm happy to kind of make sure you get the information you need. So I encourage people to ask questions throughout this. If you want to see how something works in your particular scenario, we had a gentleman that was asking me about the intricacies of doing tax deductions. I've had a lot of experience, not just in like an IRA doing this stuff, but also like mechanically how some of these things work in general, whether you're using an IRA or not. So ask questions, interrupt me. You're going to get more benefit out of this if you kind of engage and ask questions, because I can run through this presentation in 30, 45 minutes, and that's all well and good. There's great information in there, but I want to make sure that you get information that's specific to what you're doing, the local markets here, how people are investing, and again, really make sure that you leave here with some tools that are going to enable you to either utilize this in some form or fashion, and we're going to get into how this stuff can apply to you using IRAs. But more importantly, also keep in mind that you can do all this stuff and utilize other people's IRAs. Because real estate's many things, but it's not cheap. So the inflow of money and being able to get funding for your deals or doing what you're doing is really important. So with that said, we'll kind of start diving into it. Again, my name's Alex Perney. I've been doing strictly alternative investing and alternative finance since the end of 2011. Kind of like my first real job out of college. I was telling John, I have my degree with a minor in finance and a degree in business administration, and basically the only thing I use from that is algebra. Everything else, is a lot of experiential learning, but I've had a direct hand in investing and closing over 1,400 deals of individual investments when I was doing investments. I've had a hand in about $400 million of direct capital deployment, and that is strictly real estate adjacent, mortgages, tax deed sales, wholesaling, flippers, limited partnerships, private stock. So again, I have a lot of experience in this, and I want to be as useful to you as possible with that. Have to make at least a little bit of our corporate overlords happy and the attorneys. What we do here at Advanta, we don't give tax or legal advice. So anything that I'm going to tell you tonight, please make sure you trust but verify. I can't advise you on a particular situation, or I can also not endorse or promote any investment product. Granted, we're here to talk about real estate. Real estate is awesome, that's all we handle, but just keep in mind what we do as IRA custodians is not the advisory side of things. A little bit about Advanta IRA. So again, we are strictly a self-directed retirement plan administrator. So people that want to buy real estate, we don't do publicly traded stock, we don't do stocks, bonds, and mutual funds. That's strictly all we do. We've only been doing that, been doing it for about 20 years. We have almost 8,000 individual clients, and we administer about $3.1 billion worth of assets under administration. So it's something we're proud of, and it definitely kind of goes to show like the utilization of this. If you haven't necessarily heard about it, and by a show of hands, has anyone before tonight not heard of being able to buy real estate or do deals in an IRA? Everyone's that awesome, great. So at least we're starting with a good baseline. It's the education aspect of this is really kind of key. They gave you some metrics on why you maybe don't hear about it more, and this will also play into understanding how powerful this can be for getting funding for your deals. There's roughly $37 trillion worth of retirement plan assets in the United States. That's the number 37 with 4 commas behind it. So there's a lot of money out there, and roughly by the best numbers we can get, about 4% of that is self-directed, and that just means people picking their own stocks. A farther fraction of that is people actually deploying this in true self-directed fashion, buying real estate, doing deals, borrowing money, getting out there and doing this stuff. So the reason I like to bring that up is, one, it's fun to say $37 trillion, as rolls off the tongue pretty nice, but two, is that when you're out in the marketplace and you need to find money, granted you may not have a very big chunk or a chunk of that $37 trillion in your retirement plan, but other people do. People in this room do. If you're looking to talk to someone about getting funding for a deal, if you approach them and say, hey, look, I got a great line, it's a 3-2, good neighborhood, be a great rental, what do you think? Here's kind of the terms I can work out. You want a piece of it, you want to lend the money on it. And maybe they say, you know what, I kind of tapped right now, I just got things in other projects. Well, ask them, say, hey, do you have an IRA? This would be a great deal for your IRA. I could pay you that 8-10%, and instead of having to pay taxes on it, I could be funding your retirement plan with it. And if they don't know that about self-directed IRAs, you automatically untapped something that they didn't even realize they had. You brought more value to the deal, and you've also been able to tap into more of your investors' capital as well. So that's really kind of a cool aspect of this that I really enjoy. I kind of hammer that home when I talk to realtors specifically, because it helps them drive more sales. I'm like, oh yeah, I really like that. But it's also really important for you as the investor, especially if you're starting out or you're looking to get funding for your deals, or maybe you're really seasoned and you just want more deal flow. Understanding how to access more of your investors' capital is also a really important aspect of what we're talking about here today. So what is a self-directed IRA? Self-directed IRAs, you can Google search the term, you'll probably pop up. Fidelity Investments really likes to say self-directed IRAs. But self-directed IRAs and somewhere like Charles Schwab and Fidelity are not all created equal. They're just talking about picking your own stocks, bonds, mutual funds. You need a company that's willing to hold these types of assets. The IRS does not legislate on a kind of a granular level what people can hold within their retirement plans. There's a few things you can't, and we'll get into that in a minute. But it's primarily left up to the custodian, in this case someone like Advanta, Fidelity, or Charles Schwab, to say, hey, yes, we will allow you to buy that or not. It's not, again, the IRS's list of what you can't buy, it's like 4 things, right? They don't say, oh, you have to buy, a 3-2, or you can only, buy something that's, in an HOA or something. It's left up to you to figure out what exactly makes sense, and then also the custodian to say, hey, yes, we will or won't allow this. So I get asked quite often, and I'm always happy to answer, but people say, well, why do I even need Advanta? I have a bank. Why don't I just do that with that IRA? Well, again, they're going to say no. They're just going to be like, you know what, we don't do that. Or more detrimental to the investors, they'll say, you can't do that. You're going to have to take a distribution, pay taxes and penalties. And again, that might just be the lack of education they have. I would like to think it's not just, malicious intent. Who knows, right? But again, it's just making sure you have the information to make the correct decisions and understanding why a company like Advanta exists. It's important to know, especially when you're getting into this, of understanding, hey, what is exactly is going on? Why is someone doing something different? X, Y, and Z. So what can you buy with an IRA? Really, again, it is so long as you're not buying or selling something that you already personally own to your IRA, and you're not buying a disqualifying asset, which, again, the list is really short. So you can't buy collectibles, you can't buy a life insurance policy. I don't even have to open up my thumb to list how many things you can't buy with it. So long as you have a custodian willing to hold that, you can do it. So what does that open yourself up to? You can buy a house in it, you can buy a rental, you can do wholesaling. I know John was talking to people tonight, it's like, hey, yeah, I got my start doing wholesaling. Real estate is many things, but cheap it is not. So looking at this from the perspective, especially if you're getting started out, of saying, great, this information is awesome. I would love to own a rental property in my IRA, but maybe I only have 5, 10, 15,000 or less where do I get started? Things like wholesaling, things like options, doing different types of things that are going to have a lower barrier to entry that can potentially offer some great returns while being focused on real estate. You can do the whole spectrum. Again, and doing it within an IRA is not inherently too complicated. There are some additional steps that you have to take. There's some ways to actually do it correctly, but that's what we're here to help you with. You have someone like Advanta, and we offer dedicated account management to hold your hand and kind of walk you through that. So if you're saying, hey, look, I want to get into wholesaling, or hey, look, I got a bunch of money because I just changed jobs. I've been working for AT&T, or I've been working for BP or someone forever. I changed jobs and I have all this money. We can help you on either end of that stack. So I really like to make sure people, when we're talking about this, especially in the context of real estate, to understand that you can kind of plug in to whatever you're looking to do. But another gentleman that was asking about tax deed auctions. It's another great way to kind of get started in lower price point stuff with IRAs, and IRAs absolutely can plug into things like tax auctions. I'll tell a little story. Some of you, we definitely got a few more people after I told this, but one of the biggest wins that I saw from someone ever was doing a tax deed auction. It was in DeKalb County in Atlanta. He kept going out, and I won't get too far into the granular, like all the crazy stuff that was happening, but he kept trying to go after this one property. Finally bought the deed for, I want to say it was about, I'm trying to remember the numbers here. It ended up being about 120 that he bought the deed for. Had to put in about another $50,000 of quieting the title after he got the deed to the property. He turned around and sold it. Did this all in his IRA. He had a SEP IRA, which is a type of business plan, which we'll touch on in a minute. He did all of that within his IRA. Turned around and he sent me a contract after he got everything quieted with the title. Sold it for about $1.2 million. You want to know how much? Anyone want to raise their hand and say how much tax he paid on that? Like $900,000?
Zero.
Oh, we got winners. I have nothing for you, but you get a big thumbs up for me. You get some good energy going into the world for getting that one right. But again, that's certainly not normal. I mean, that's 13 years. I've seen one person do that. So just keep in mind. But if you boil that down, if you say, hey, look, I want to wholesale this property. You get something under contract for a couple grand, and you maybe sell it out, and you sell that contract on an assignment, and you sell it for $1,000 assignment fee. Well, what's the percentage of $1,000 to $5,000? Well, math, 20%.
Yeah.
You make 20% on your money, and how much tax did you pay? Zero. Especially if you're doing something like that through a Roth IRA. You start talking about these returns that you're paying zero in taxes on, and if you're doing things like wholesaling, that could potentially be ordinary income to you if you're doing that within the same calendar year. And most people aren't going to want to hold a contract for a whole year, so the impetus to get those things turned around if you're wholesaling is definitely there. You can just turn and burn these things, and again, hopefully to good success. And maybe you're not selling them for $1,000 assignment fees. Maybe it is $500. Maybe it is more than that. But the nice thing is that you don't have to worry about putting this stuff on your personal tax returns. It's all going into the IRA. So although it's a different way of thinking about it, it's actually really simple at the end of the day from a tax perspective. None of it goes to your personal income tax statement. I always like to draw an equation kind of to what most people are used to. You have an IRA, let's say you bought Microsoft with your IRA, right? You held it, you sold it, you made money, you didn't pay any taxes on that. It just goes back into the account. That same style of thinking of just everything being in another bucket holds true with this different type of asset class. So again, you can just kind of, rinse, wash, repeat. And the nice thing is that the term compounding interest gets extremely visible here because you take all of your earnings, invest in the next one. It gets bigger. You're paying no taxes. And the ability to compound that stuff at a much higher rate than what you do personally, while not having to do any complicated stuff like a 1031 exchange or calculating your applicable basis or taking all of your interest and expenses and trying to reduce those taxable numbers by as much as possible, while also making sure you have enough money to pay taxes. I like it. Anything that makes my life simple, especially when it comes to taxes, is awesome. So to get back a little bit on track of really kind of what I want people to understand, again, what are your options? Again, real estate, we probably administer about $1 billion worth of real estate. And that is all kinds of different stuff, whether it is apartment complexes, whether that is people investing into portions of other people's deals, wholesaling. You can lend people money. So if you don't want to be involved with tenants and toilets and you'd rather be on the money side of things, you can lend someone money. You can hold a first position mortgage on someone's property. You could potentially wrap someone's mortgage with a secondary position. You could lend someone money on an unsecured basis. You can get real creative with this stuff too. I've seen people do equity participation where they lend someone money out of their IRA. They don't get a fixed rate of return like an interest payment. They get a portion of the gross rents, or they get a portion of the equity at sale, or the profits at sale back into their IRA. You can get real creative with this stuff. It doesn't have to just be the most vanilla stuff in the world. Get creative, make it work. It's really cool when you start looking at all the different creative ways that people put together deals, and then start looking at it through the lens of an IRA and paying zero in taxes on it. So again, creative deals work awesome within IRAs. You can also buy precious metals. You can also do like foreign currency exchange trading, future trading, a whole lot of stuff. But again, we'll focus on the real estate because we're at a REIT, right? And the other cool thing is that, with government comes change, right? Every 2 to 4 to 6 years, they like to come in and change all sorts of fun stuff. But the nice thing is that this is not new. IRAs have been around. For a little history lesson for anyone that wants to go on Jeopardy one day, this stuff has been around since 1975. With the passing of a piece of legislation called ERISA, which is the Employment Retirement Income Securities Act of 1974, Alex Trebek, these things came into being. And you've been able to do this kind of investing since the mid-70s. So since the Carter administration, this stuff has been in the market. The problem is that big banks make a lot of money just selling you a CD or a brokerage option that people just find easy. And for some people, it works. Self-direction is not for everyone. But if you're sitting in this room and you're interested in real estate, it's for you. but it's just that alternative kind of self-motivated thinking that so many people in real estate have lends itself very well to being able to do this kind of investing. But I do like to make sure people know that this stuff is not something that's just going to probably go away the next day. They start messing with IRAs too much, that's when, pitchforks in the street. That's not something that really goes over too well with the US populace. Granted, they will mess with it, they'll do some different stuff, but as far as these kind of options and being able to do this stuff, I've started my career in, the first Obama administration, so still around. And really nothing too fundamentally has changed. So some things I'll let people know. It's important to understand how you get money into these plans, especially if you don't have one yet, or maybe you have a 401k, or let's say you have an IRA currently. How do you kind of get stuff moved around? Is everyone in here familiar with contributions to an IRA? We'll show of hands. Okay, cool. So it's about half and half. So basically, the way it works is that with an IRA, the government says you can put so much amount out of your own personal income in there per year. That is completely different from how much money you can earn in the IRA. IRA earnings are unlimited. So if you hit a home run, or let's say you have a substantial amount of money in an IRA and you're making more than the allowed contribution limit, two different things. So you can add in $7,000 or $8,000 just out of your own pocket every year to an IRA. So if you're just getting started, you want to put some money in there. So long as you've made at least $7,000 or $8,000 in a given year, you can put as much of that as you want to. You can put $100 in. You can put the full maximum in. It's a sliding scale. You don't have to do the whole thing. But that is depending on whether you are over or under the age of 50 and a half. Under 50, $7,000. Over 50, $8,000. So you can put that in there. That's where you can get started. Or if you've been doing IRAs for a long time, continue to make those contributions. Two main kind of account types that people always, think about are Roth and traditional. A big misnomer that I hear a lot is that people say, oh, well, I have to have a Roth IRA to do this. You don't. Any of the kind of accounts that we're going to talk about tonight can do any of these kind of investments. Now, are Roth accounts really cool? Yeah, they're sexy. You pay zero taxes on the back end, but you also don't get a tax deduction for putting money into one. So, keeping in mind what your current needs are, if you haven't kind of already had a retirement plan for a while, is very important. I would say most people kind of starting out, you're talking about writing off $7,000 or $8,000. Roth IRAs are great. You're not really reducing your taxes by a whole heck of a lot with that. And depending on how much money you make, it is a sliding scale in deductibility for that. So Roth IRAs, if you're just getting started, are really awesome. They also offer you the ability to distribute your contributions tax and penalty free at any time. So again, for those of you getting started, understanding that the Roths have kind of a hybrid built-in like savings account, if you will, that you can always access, really a cool feature that I don't really think gets enough press. But again, that's something that I really like, that I like to make sure people know. Because another downside, because it's great to talk about all the plus sides and the upsides to this, but a downside that people say, well, if I put money in an IRA, well, I can never touch it again. Well, again, that's true to the point that you can only do penalty-free distributions at 59 and a half, but you can access this money. But again, if you have to pay Uncle Sam a 10% VIG just to get your money out of a plan, that can be a little bit of a problem for some people, especially if you're getting started. Some of the stuff doesn't necessarily apply. Let's say, again, if you maybe have 100 or 200 in a 401k and you want to start rolling over to do this, again, making sure that the whole stack of people can understand where some of this stuff has benefit and where it has some drawbacks is important. So that brings up the other part, is that yes, anything that you're doing within this has to stay within the umbrella of the IRA. So when you're doing investing, you're doing deals, all of the income comes back to the IRA. That's what kind of leads into the simplicity from a tax reporting perspective, but it's also saying, well, I want to get some of that money out of there. It's really important to kind of, again, divorce what the IRA is doing from yourself personally. Retirement plans, again, are for something at a long future date. They're out in the future. So thinking about it from the perspective of saying, okay, this is a long-term play. And you can be way more active with it and try to build it up, but the ultimate benefit when you're going to start getting money and returns out of that should be, in your mind's eye, probably farther down into the future. So again, some people have a little bit of an issue with that. And again, it's just kind of a mindset thing. With anything in life, this mindset plays a ton into it. So that's kind of the Roth and traditional. Again, high level, one's tax deductible on the front end, one is no tax deduction going in. But the difference between a Roth and traditional is, one, you pay taxes on the way out. So you take $1,000 distribution from a traditional IRA retirement, you pay taxes on $1,000. You take $1,000 distribution from a Roth or retirement, you pay zero. Pretty cool deal. So paying no taxes is better than paying some taxes in a lot of people's eyes. But again, it all kind of just depends. The other kind of accounts that people kind of use for self-direction, if you are, let's say, a partially self-employed person, or you have, you're a full-time investor, things like SEP IRAs, solo 401ks are awesome. I am a huge nerd for 401ks. I find them incredibly interesting, and the benefit that they offer to people, especially those of you that maybe have, let's say you have a property management company, or you run a few rentals through an LLC personally, or you have some type, you sell widgets on eBay, right? Having these kind of plans can be really powerful because, one, the amount of money you can get into them is significantly higher. So again, you can earn as much money as you want in any of these kind of accounts, but the amount of money you can get into them can be a little bit constricting. So a SEP IRA, super easy. It stands for Simplified Employer Pension. For once, the government named something that was actually pretty accurate. So it's basically you take your total comp at the end of the year. So if you're a self-employed individual, you have rental income or management income coming in from a business, you take that number, multiply by 0.25, and that gives you the amount of money you can put in there, up to $69,000. So $69,000 is a lot of money. It's a lot more than $7,000 or $8,000. So it lets you put a lot more money to those kind of plans. And the cool thing is, it also leads into something that's not very cool with the government, is that that's all tax deductible. As of last year, theoretically, you can also do them as Roth accounts. So you could have $69,000 completely above board, with no weird stuff going directly into a Roth SEP. Funny thing with that is that the government wrote the legislation. The IRS has still not written the reporting codes for us to even allow people to do it. So we have this nice big piece of tax legislation that says, hey, you can now do this awesome stuff. You can get all this money in Roth plans. In theory, we could open the account, but we have no way to tell the IRS that someone's actually done it effectively. So still no SEP IRAs, Roth SEPs, but I digress. 401ks, I won't get too far into the nuts and bolts of it, but suffice it to say, they also get up to roughly the same amount of money. You can do those as Roths. You can also borrow money personally from 401ks. They allow for some creative financing structures when it comes to doing like debt leveraged real estate. That's really cool. Again, I really like 401ks, but that's a little bit of kind of like a little bit more of an advanced topic with a lot of numbers that will probably put you to sleep. So if you have questions on more of the employer plans, grab me afterwards. I will be at the little after hours thing. Happy to go through that. But again, those get up to roughly the same amount as a SEP IRA as well. You can also self-direct education savings accounts. I personally self-direct my 401k and my health savings account. Health savings accounts are awesome. So I have a client in St. Pete, Florida, where I'm from, who owns he just sold one. He had 3 rentals in his health savings account. Started with maybe 50 or 60 grand in a health savings account, and now it's $750,000 worth of real estate with 300 grand of just cash in his health savings account. I mean, that's pretty cool. So he could actually get hit by a bus and afford it in the United States, which and afford the bill on that. But the cool thing with HSAs, and just again understanding some of this stuff, is that HSAs give you a fully deductible tax write-off going in, no matter how much money you make, and it is dollar for dollar deductible, unlike a sliding scale with traditional IRAs. And again, you can reimburse yourself in perpetuity for any medical expense, so long as that it wasn't reimbursed by insurance. Again, a little complicated with that. But once you reach 65, you can treat an HSA like a traditional retirement plan. So you can just you just pay taxes on it. You can do whatever you want to it. You can go to Tahiti, you can put a new roof on your house, or you can hopefully pay the crazy insurance rates that come with living on the Gulf Coast. There's so many cool things you can do with all these different kinds of plans. And just to recap, we do traditional and Roth IRAs, we do SEP IRAs, solo 401ks, ESAs, and HSAs. Any of these can be self-directed. So now let's kind of cover how people get money into these, because not everyone just starts in the beginning. If you have an old 401k or you have an existing IRA, you can roll those funds directly in to a self-directed IRA. You don't have to start these from scratch. So if you have an IRA, let's say Schwab or Fidelity, it's as easy as just opening an account with Advanta. We fax them a request, and yes, we send a ton of faxes. People always ask me, it's like, you really have to do them? I'm like, you'd be blown away by how much stuff gets faxed in the finance world. It's a lot harder to hack a phone line, so sure, someone will figure that out eventually, but yeah, we fax them the request, they wire us the money, you're done. With a 401k, there are some restrictions to keep in mind, because a lot of people after they hear me talk about this, or they do some more research and say, this is awesome, why am I doing what my employer's giving me? I'd rather do real estate than the S&P 500 index. Well, if you're still working for an employer and still what's called in service, or still in service with the company, they can restrict your movement of 401k funds out to an IRA. There's no taxes being paid on the movement of a 401k account to an IRA, but if you're still working for them, they have the ability to restrict you if you're under the age of 59 and a half. The problem is that there's no kind of uniform way to figure it out. You got to get on the phone and call them. They're going to give you 1 of 3 answers. No, you can't do it. 2, you can roll over whatever you contributed to the plan. Or 3, if they're feeling really generous, they'll say, yep, you can roll over as much as you want, you're good. So again, that's how you get money into these plans.
So you could have the 401k with your employer and still have your own?
IRA?
Yeah, you're still contributing when you go to work?
Yeah.
And then,
So the high level answer is yes. You get into a little bit more of the weeds when you talk about how deductible some of those contributions are, but I'll use myself as an example. I have, I guess I kind of practice what I preach, I have a lot of accounts, but let's just say, for illustrating that point, I have a Roth IRA, I have a traditional IRA, I have an HSA, and I also have my company's retirement plan. So I try to play around with how much I'm being fleeced for in taxes every year and what I'm putting in each. But I put in, some years I'll put into my traditional IRA. If my income was a little bit lower and I also want more deductions, I'll do that. And I also contribute to my workplace 401k. Deductibility is a little bit heavy, but you can max out your IRA contribution and max out a retirement plan contribution at your employer. The contribution limits are per person. So the next kind of thing people say is, oh, I'm just going to open up 10 IRAs and put all the money in there. No, it's $7,000 or $8,000 across all of your IRAs. So yes, you can be covered by multiple plans. You can also participate in multiple 401ks. I have clients that have jobs with 2 different people, or let's say they're self-employed, they have a solo 401k, and their 9-to-5's 401k as well. So Yeah, absolutely. You can have multiple of these. Again, your contribution is the only thing that's going to be limited. And although further to that, you don't have to do all or nothing with this. If you want to have, let's say, your account at Fidelity and you have one deal coming up, okay, great. I'm going to do that one deal with John where he's looking for some money. I'm going to lend him the rest of the money on that deal. I may not necessarily need to lend him everything in my IRA, so I could keep what I have at Schwab, transfer just a portion to Advanta, and then do that deal. You can have accounts at multiple places. You can have multiple accounts. Again, it's not saying, hey, I want to do self-directed. I got to really jump in, fully do it. You have the ability to kind of make this as effective for you as possible by blending what kind of accounts, where you have the accounts, what you're investing in as well. And again, thank you for being the first one to ask a question.
Well, so also, if I have a 401k and I want to start an HSA, can I use the 401k money and put that in there?
So, I'll answer the question. HSAs are a little bit strange in that you have to have qualifying, what's called high deductible healthcare plan coverage or HDHP coverage. The best way to figure out if you have the right coverage to even have an HSA is call your insurance provider. If you have qualifying healthcare coverage to have the HSA, you can open it. You can do a one-time funding rollover from a qualified retirement plan, but only up into the HSA contribution limit. And you don't get a tax write-off for it. So you can also do it from a Roth account as well. I would highly encourage you probably not to do that because you're taking money from a completely tax-free source and putting it into something that's going to be taxed now, potentially be taxed. But yes, it's just, it depends on your healthcare coverage. And again, I could rattle off the weird formula that they use for it, but the easiest way to do it, just call the insurance provider and say, hey, is this HSA coverage? If they say yes, open up an HSA, go forward from there. Yes?
Would you please go back and repeat what you said about you can take some of your money out of 401k and move it after your whatever age that was? Or did I misunderstand?
Maybe, but again, that's perfect. I mean, if you misunderstand, happy to kind of go back and see if it kind of addresses that question. So once you are over the, I think I know where that came in. So if you're under the age of 59 and a half, employers can generally, and they do, restrict your ability to move funds out of that plan while you're still working for them. So let's say me, I'm 35. I go to Advanta and say, hey, you know what? I want to roll over funds from my Advanta plan to an IRA at Fidelity. They could say, nope, our plan does not allow for that. They could say, you can only roll over what you put in, nothing we've matched. Or they can just say, yep, whatever you want to roll over, you can roll over. The reason 59 and a half plays into factor here is that's the general IRS date of retirement. That's when they say people start retiring at 59 and a half, so that's when you can start taking money out of those plans. It leads into the penalty-free distribution from traditional IRAs, the fully beneficial distribution for Roth IRAs. So again, you're allowed to take money out, so that's when you can generally start rolling over if you're still working. If you sever employment, that employer has no ability to restrict anything. So you no longer work for them. They can't do anything about it. You can roll over those funds to wherever you'd like to go with that from that point. I think that's answers your question.
So it's really not an IRS thing. It's more of your company's policy about if, when, and for how, and what percentage if they're
Yeah. So the IRS has some general, and the fun thing with 401ks is that you have two different bodies legislating it. You have the Department of Labor and the IRS. So a lot of fun regulations for that. But in general, when you're looking at it, when you set up a 401k, like if you're a business, they used to call them cafeteria plans for this exact reason, is that you go and you can kind of pick, okay, we want to offer this benefit, we're going to have this go into it. And when you set it up, the employer used to say, okay, we are going to or not to allow certain things. The problem is that they have to treat everyone equally. It's part of fair labor practices for the Department of Labor. So if they say that from the beginning, they either have to change it for everyone or keep it the same. So you're kind of stuck with what they say. You can't kind of plead your case to the higher ups because they'd have to amend the entire plan for it. But again, it's the employer's choice at the onset, not necessarily specific to you. It's across the board for the entirety of that plan. Cool. Any other questions before we start getting into really?
If I max out my contributions in my self-directed IRA, basically, could I then make contributions to the HSA and still avoid getting taxed on that? I guess.
Yeah, so contributions to any individual type of plan are separate, right? So your IRA contributions, you can't exceed that 7,000 or 8,000 between Roth and traditionals across all of your plans. You have a separate bucket that you look at for something like a 401k. It's a separate bucket for an HSA. So case in point, I try to make it a point to max out my HSA every year because I basically, for my HSA, have to pay out of pocket for everything up until my total out of pocket. So I like to make sure there's money in there. Also a great tax deduction. I also do add money into my IRAs and my 401k. So again, they're all individual, just because they all kind of fall under the retirement plan umbrella. You look at them each individually. So it's not like 7,000 between your IRAs, HSA, and everything like that. It's individually calculated. All right.
Thank you.
Yeah. All right. So what kind of options do you have? Well, let's do rules. Okay. So here's some rules. Before we start kind of getting into where the rubber meets the road on how this stuff is actually done and what some of the numbers kind of look like as far as like a case study example of what we're doing, it's important to understand what governs this, right? Because it's not just as easy as saying, great, I can do real estate, off to the races. So remember, there's two things you cannot buy, right? Can't buy life insurance, can't buy a collectible. You can buy gold and silver and platinum and palladium coins, but they can't be like rare ones. It just has to be like whatever the bullion content of that coin is. But again, life insurance and collectibles. Can't do it. There's also certain transactions which are called prohibited transactions. And we'll do some case studies on this because it's not something you're ever going to really run into just doing stocks, bonds, and mutual funds. It does definitely come into play with real estate because it's a much more of an engaging asset class. It's not just, in the ether, okay, I bought Microsoft, Tesla, this exchange traded fund. That's what you're investing in, a piece of real estate. It's something you can reach out and touch. And reaching out and touching it can cause you issues. So prohibited transactions is a transaction between the plan, so the IRA or the 401k, and a disqualified individual. So there's certain people you cannot directly deal with, and these disqualified individuals also cannot receive a direct benefit from an IRA asset. And again, we're gonna kind of translate that a little bit for you. If anyone wants to take notes, the Internal Revenue Code for that is 4975. It's actually kind of easy to read from the IRS's perspective. And then there's also some considerations if you're going to be doing debt leverage deals. So if you're going to have the IRA be in a position where it's going to borrow money. So I'll get into kind of some of the ways that people structure this to kind of maybe alleviate some of those potential issues that you might run into. So again, life insurance and collectibles, and there's certain people you cannot directly deal with. So who are the people that you can't deal with? One is yourself. You also can't deal with basically anyone that's in your family tree directly up and down from you. So what does that mean you can't deal with them? So let's say, for example, your IRA purchases a piece of real estate from your child. Can't do it. Your child owns a piece of real estate. You can't buy it or you can't sell it to them. Also, those people cannot directly benefit from the property. What does it mean to benefit? So they rent out, be the actual property manager for. Not that you have to hire a third-party property manager. I'll kind of get into that a little bit in like the functionality of buying real estate. But a good example of that is I had a client that was buying a property in Auburn, Alabama. For whatever reason, he thought it was going to be a fun idea to rent houses to college kids. I mean, better him than me. I was a college kid not too long ago, and I would have rented to me. So there's that. But he bought a property in Auburn, Alabama, and right as rain, he closed on the property and he sends me a lease. Look at the lease, and a woman with the same last name was listed on there. So I called him up. I'm like, hey, just noticed the same last name. And he's like, oh yeah, my daughter and her 3 friends are gonna rent the property. Yeah, there was market rent. There was nothing odd about it, but the IRS says you can't do that. So again, these are not necessarily things when you think of like running afoul of the IRS where it's like cheating or dodging or something like that. There's just functional things that you need to be aware of that you can't do and certain people that can't invest with them. Try to think of the IRA as just a general golden rule, arm's length. Keep it arm's length from your family, keep it arm's length from yourself, and that will solve about 90% of the issues that you could potentially run into with these plans. So again, direct nuclear family, your spouse, yourself personally, deal outside of that bubble and you'll be fine. for whatever reason, the IRS does not have a problem with siblings. So if your brother runs a construction company, they can come over and do all the work on the property that you want to. If your sister is someone that, I don't know, with anything else in real estate, they can do everything else as well. So just keep in mind, left and right, aunts, uncles, cousins, brothers and sisters are okay to deal with. Granted, if you're going to be dealing with family, you got to be okay with maybe having a really awkward Thanksgiving dinner, but if you want to do that, you're certainly able to deal with those people. Again, personal, spouse, mother, father, son, daughter are people you can't deal with. They can't do the work on the property. They can't rent the property. You can't buy or sell something to them. They can't finance it. Just stay away from dealing with those people in your IRA. And again, like 90% of the issues that you could run into, you'll be all right. Question?
So it's pretty specific, and I erred on the side of caution, but I want to know what you think. I loaned the money to purchase the property.
Mhm.
I'm a real estate agent, and I made sure not to be the buyer's agent because the 401k was involved in loaning money, the mortgage.
Okay.
So could I have been the real estate agent on the buy and sell side?
So it's, I would say it's definitely a little bit of a gray area. From the perspective of just kind of coordinating the deal, again, I don't necessarily see too much of an issue with it. Where it comes into play is that, okay, well, in real estate, there's commissions that have to be paid, right? So what are you going to do with that? Most often I've seen people that want to engage in that, and I'm not here to say you should or shouldn't do that. I definitely come from the perspective of saying, be careful, understand the rules and risks, make an informed decision. Do I think it's as, like, right up against the line as something as dangerous as, like, other things you could do? No. It's on the spectrum, but it's maybe a lighter shade of gray than a darker one. What I've seen people do is go, okay, well, if I can't take a commission, let's negotiate a discount if you're on the buy side. Or if they're on the sell side, okay, great. Well, let's take my commission that otherwise would have had to have been paid in this transaction. And if you know someone in real estate, maybe curry a little favor. Say, look, I can't be involved in this deal. Let me in on something else. Let me eat, and you'll get to take this one for me. If that's not the case, then again, I think it might be a little bit, some arguments to be made to say, okay, well, instead of me taking the commission, let's go ahead and bump up that total due to seller a little bit. Again, there's varying degrees of what could be considered gray there. I think functionally, just acting in the capacity as a realtor just to get the property out there and sold, not too much of an issue. It's just mainly kind of boils down to that benefit of saying, okay, again, direct personal benefits what the IRS has an issue with. So commissions, easy enough to say. The stuff that's a little bit more theoretical or kind of in the ether, again, it's hard to kind of nail down, but that's my take on it.
Great.
Yes.
Back to disqualified persons, do son or daughter-in-laws count? Are they?
So so son and daughter-in-law meaning like the spouse of a disqualified individual.
Mhm.
So yes, from the perspective of saying, okay, well that's a married household. So if let's say your daughter or your son is a beneficiary of your retirement plan in the event of your death, then that would make it a disqualifying individual as a household because they're filing a joint tax return as a single household. So yes, basically when you get out of that bubble is when you start going like once removed from your direct lineage. So think sisters, brothers, cousins, aunts, uncles, nieces, nephews, like anyone in those kind of family trees is okay to deal with. But you have to keep in mind is that the little bit more kind of nuanced part of that is that you can't name them as a beneficiary of your retirement plan. So, inadvertently, yes, could you deal with them? But if you named your sister as the beneficiary of your retirement plan, they become disqualified. So, again, I just recommend people deal outside of your family. Yes.
So if your spouse is the one that has the IRA 401k and you're the one that's wanting to, the other spouse is the one that's wanting to do the investing,
Mhm.
what is the point and how will they end up being able to do transactions if the spouse is the one, that's lending the money to the other spouse?
Well, you just can't do it. I mean, it's like if you wanted to buy and do deals, you just can't deal with the IRAs coming directly to you. So if your spouse, had a 401k and you wanted to go out and do a deal personally, couldn't do that. They couldn't lend you the money. But I would say in that same scenario, just have the retirement plan do the deal directly. Just remove yourself from that situation. So like if you wanted to go out and buy and rehab a property, instead of you doing that personally, just have the 401k or the IRA do it. That way it's all held in that bucket. You're not having to deal with that disqualification of lending money. Granted, you are giving up that direct personal benefit though. So you're not going to be able to personally capture that cash flow. And you have to kind of look at that from that lens that I said at the beginning of saying, okay, this has to be long term. So if your ultimate goal right there was to be able to generate positive cash flow that goes directly into your pocket now, yeah, that is a trade-off. But at the end of the day, the 401k, long term, basing the assets in something tangible, that's where you get the benefit along with the taxes. But with anything in life, there's a trade-off. Yeah, John? And I got those.
Can't you joint venture with your IRA?
Yep.
So you can both invest equally and benefit equally?
Did you read my slide deck?
No.
You mean individually with your own,
Yeah.
401k?
Yeah, so we'll dive into that. There's a few other questions. I'll just make sure we bucket that one because that's kind of like a bucket to get through. Question?
Yeah, this is why financial friends is really important with the disqualified parties. Because at the end of the day, some people are like, well, I don't want to put a rental, into this. I can't get the cash flow, right? But you can do deals with other people. Before I got my first account, all of my interactions had been, all my private lenders had come from friends who wanted to grow their accounts. And so, but then now that I'm growing mine, I've got to be doing, certain deals in them and stuff like that, and then dealing with financial friends who I have vetted and trust doing the deals with to help grow it.
Yeah. Someone knows Pete. I like when he says that. But yeah, that's a very good point. And I actually, since we didn't have a thing, but I have a fun slide, and I think you can really see it. But it's invest with not only what you know, but with who you know as well. I know it's corny as heck, but the message is very powerful. Is that a single tweet from a fund manager is not going to tank your portfolio in real estate. If you're investing for cash flow, you buy it for $200, it goes up to $3, it goes down to $1. But if you're renting it out for $1,500 a month on annual leases, what's it matter what it's worth? You get to invest basically price point agnostic. I mean, to a point, you don't want to overpay for something and then not be able to kind of make a realistic cash flow on it. But the nice thing about it is that your returns are, they are to a point, but they're not like at a very real time level based on the underlying value of the asset. McDonald's stock goes down, by 20%. Well, your dividend just went down by 20% as it relates to that share price. Your house goes down 20% in value and you're still renting it for $1,500 a month. Well, cool. I wasn't planning on selling it. I just want the cash flow. So again, that's very cool. And again, to her point, kind of illustrating, I think the issue you were having back there is that, having those friends, you're being able to, utilize other people's IRAs or other people's money to kind of make these things work is, again, a very powerful part of this. Now, to John's question about joint venturing, yes. So if you wanted to be a part of a deal and you wanted to get some IRA money working in that, remember, you can't buy and sell from your IRA. You can't be on opposite sides of the closing table, right? But you can come in together as partners and partner on a deal, meaning that from the very beginning, say, okay, and again, we'll just use these numbers, right? Say it's a $100,000 property, my IRA brings in 50, I bring in 50. We buy the property, right? Now from there, that's great on a high level, great. I get to have a deal, I get to have skin in this game, my IRA has some skin in the game, but it does add some complexity to it. The IRA can only get 50% of what's coming in for that. It's also liable for 50% of any and all expenses. So are you. So you have to delineate those expenses and that income accordingly. Can you do that without any other types of entities or things going into it? Yes. Most people, though, would elect to probably go through something like an LLC, where you form a new LLC, you come in as a 50% partner, the IRA comes in as a 50% partner, and that way the income and the expenses all flow through one entity instead of having to be like, tell your tenant, be like, you get to make out 2 rent checks. Like telling a vendor, say, hey, look, here's my $500 of that water heater. You're gonna have to wait 3 or 4 days to get the other one from my IRA. So again, it's for simplicity's sake, most people, when they start doing partnerships like that, will form an LLC, and you're not limited to just doing that with two people. And again, you have to keep in mind that also does bear a little bit more scrutiny from yourself on doing it, because just like, it bears a little bit more scrutiny from yourself, because again, remember, you have to be careful of those IRS rules. You can't float an expense for your IRA. So you can't, collect more than your due share to yourself personally or vice versa. So you just need to be really careful when you partner. Can you do it? Absolutely. Just be careful when doing it. You can also partner with a bunch of different people. You could have 4 or 5 different people that come in on a deal. Let's say it's a bigger deal, or you want to bring more people together, and that's what you want to do. You want to have 3 or 4 partners on a deal. You want to do some joint venturing. You can have individual people. You can have another LLC or another trust or multiple IRAs. It doesn't have to be the same kind of entity coming in. I've seen people that have had, like someone's trust, someone's 401k, their IRA. They have a whole bunch of different things coming into this one LLC or other entity. You could theoretically do it with a trust as well, or a limited partnership. It's not so dependent on that. Just think entity they come together and partner on, and go forward from there. You got a question in the back?
Yeah, as far as being the person who's not allowed to participate, like, I can't give a wife, give her money, disqualified.
Yeah.
Disqualified individual, does that also include the entities that they might own, like she owns a business, so I can't include that business?
Yep, that's a good question. That one gets asked next. People say, oh, well, it's not me, it's my LLC. The IRS views it as one and the same. From a legal and liability perspective, yes, they are separate. They have their own buckets and everything, but for the purposes of this, an entity owned or controlled by you is also disqualified.
So another question, I'm sorry, second part of it.
Yeah.
If I say my RA, I loan to Courtney, and Courtney turns around, can she turn around and pay me to remodel the house?
Well, I mean, that's kind of the thought experiment, right?
Remember, you're being videoed.
It's the thought experiment, right? I would say is the IRS looks at intent with that. And also a fun fact for any of you that like to be very creative, another Jeopardy question for you is that unlike criminal court in the United States, where you have a presumption of innocence in criminal court, tax court, you have the presumption of guilt. So, don't go to tax court. It's not fun. Not that I've ever been, but that's fun. But anyways, again, they look at intent, right? So if you went into this with the intent to have your IRA, to do that, to circumvent that, the IRS is going to have a problem with it. Now, again, what's the bigger thought there is that, okay, great. Well, if I lent someone money, and let's say I also needed to borrow money from them, is there an argument to be made that's saying, oh, well, how can you prove that the funds didn't just kind of circumvent that? And that's a fair point. There are attorneys out there that I've talked to that have differing opinions on saying, yes, if you're invested with someone with the IRA or vice versa, you couldn't do a different deal with them. I have met with attorneys that I wholly respect their opinions on like 90% of things, and I've seen 2 different people I know, but the tax court, I won't name names or anything, but again, that have differing opinions on that. So again, there's a lot of kind of a little bit of a what ifs with that question. I would say just typically err on the side of caution. Again, they look at intent. You have the presumption of guilt. Better to be safe than sorry. Yes.
And if this is on a future slide,
Yeah.
you can earmark it. The advice I got, so again, for years, my interaction had been my private lenders were lending from retirement accounts.
Mm-hmm.
I was helping them get them set up, all that. Last year when I opened up my first account with you guys, again, I'm limited to my interactions. The advice I got was, because I knew at some point I was gonna mess it up. Obviously I call you guys a lot to say, hey, am I doing this right, whatever. The advice I got was, I actually went with a solo 401k, because the consequences if you mess up in a 401k versus an IRA are less. And so I don't know if that's a future slide or not.
It's not necessarily, but it bears some illustration. So it's all well and good to talk about like what these rules are, right? But it's important to also understand like what's the consequence. It's like what's the consequence for speeding? It's a $5 speeding ticket. Well, okay, go 10 over, whatever, you're gonna pay it. If it's a $1,000 speeding ticket or a $10,000 one, okay, you're probably gonna go the speed limit of 300, right? So the way it works with disqualified or prohibited transactions, and again, just like with everything in tax world, there's a spectrum to it, and it depends on how voracious the IRS is in pursuing it, and two, that they find out about it. You know, for all the shortcomings that people can opine about the IRS and the government, we still live in one of the, I think we live in the lowest audit rate society in the world, right? It's like something like 1.7%, right? It's extremely low. So one, for them to find out about it, they would have to somehow be made aware of that. Typically that's through an audit, and the audit has to extend to the retirement plan, and they have to then in turn go and look and find it. So again, unless you're doing something like, and again, to give you some perspective, in my now 13th year in doing this, I have seen 3 IRAs be audited, and I have only seen one person have the IRS come down on them for a prohibited transaction. The IRS elected not to disqualify the plan. But the potential problem that you can have is that the IRS, if you have a deemed prohibited transaction, they can come, and it's a 7-year testing period, just like with an audit, goes back 7 years. They can say you committed a prohibited transaction this year, it will effectively disqualify that retirement plan. So if you had, let's say, a $100,000 retirement plan, right, and they found 5 years ago that you have committed a prohibited transaction, they will say, as of that year, the IRA is fully deemed distributable. So if the IRA goes away, right, now you have to go back and refile your subsequent tax returns. You have to claim all that as income. So you have to pay potentially an early distribution penalty of 10%, a prohibited transaction distribution penalty of 15%, plus all the income taxes associated with it. And you have the asset protection and the tax qualification status stripped away from it. So conservatively speaking, you're probably going to lose about half the retirement plan. Depending on how much money you also make, could be more than that. So yeah, not a very fun day. Again, the likelihood of that happening is low, but do you want to risk it? Probably not. What she was asking about with 401ks versus IRAs, there's a little bit of a different rule there. So a 401k, if you were to have found you committed a prohibited transaction and they wanted to apply the maximal penalty, it would be 10% of the value of that prohibited transaction per year until corrected. So if you had a transaction that was valued at $100,000 and they found it, you pay a $10,000 penalty, and you need to correct it. Granted, if you're investing in something like real estate, it could be a little bit harder to do, especially if it's like a partnership deal that has something complicated going on. But effectively, the plan stays in existence, right? It does not get blown up or destroyed. So if you're someone that wants to kind of, again, walk that line a lot closer than other people would, again, I'm not here to say one way or another, but utilizing a 401k can offer you a degree of, again, it would offer you a less bad day if the IRS were to come down and say, you know what, you did something wrong. Again, the IRS can also say for IRAs, they can also say, you know, it's not like all or nothing. They can say, you know what, you committed a prohibited transaction, we're gonna treat it as an over-contribution and make you pay a penalty. They can do it for a variety of things, but they can disqualify a retirement plan. Yes.
I was gonna say, I looked into this a few years ago, 1 year ago, when my wife had a separate LLC I wasn't even a part of. I was gonna use some of my self-directed IRA money because it had come out of another transaction. And so on this technicality, I had heard about this and I wanted to do a joint venture. And the biggest challenge I had, technically speaking, I think is possible. Finding people that'll be willing to help you and sign off on it and do the transaction. Most people don't want to touch it with a 10-foot pole. The bank, the lender, because I was going to basically put her 20% deposit down. She was going to borrow 80%.
Yeah.
It would be 80-20, and nobody wanted to touch that.
Why don't you borrow from someone in the room?
Yeah, so
Doesn't have
that's
to
a
be
huge,
Right, so then you have to
that's the
find
financial
friends.
friends part.
Yeah.
Then you have to find friends.
And again, that is a point. You know, especially if you're going to talk about, and again, there's only so many there's so much cool stuff about this. But one of the issues is, especially if you're going to have an IRA and you want to have the IRA borrow money. So again, real estate is expensive. If you just want to look at this as a very like baseline thing. Say, okay, my IRA wants to buy this house. Okay, great. I have 20% of the down payment. I'm gonna go borrow the rest. The types of lending that you have to have for an IRA to actually do that is very specific. It's normally more along the lines of what you have in commercial real estate. And a lot of people don't write non-recourse loans for single-family residents. So again, you're not getting a Fannie Freddie loan. So certain deals are just a little bit harder to do. And that's, again, why partnering is so popular. Doing joint ventures, making deals work cash, or people being on the debt side of things. Debt is very popular in IRAs because, one, you don't have to deal with liabilities. And to quote a big investor that, if you don't know him, you should, Pete Fortunato, is that when someone walks into a house and trips, they don't trip over the mortgage that's laying on the threshold. They trip over the threshold that hasn't been repaired after 10 emails and sue the owner. So there's something to be said for that. If you want to stay on the less litigious side of things, lending people money, also you can get really creative with what you lend people money on. People don't always just need everything for the purchase price. Maybe they need some rehab costs. Maybe you want to work it out and say, hey, look, instead of paying me interest, pay me part of the rent. Get creative with it. There's lots of different stuff to look at. Question?
On the joint venture thing, can the IRA serve as the silent partner with 100% of the funding while you do the management and 0% bring it to the table? Or do they have to both be funded?
No, it has to be cash on the table. Yeah, if you're gonna have
$50 or
no, it can be whatever it is. But let's say it's $100,000 and the IRA has, $90,000 and you have $10,000. Well, you have 10% of the deal. It's direct. Percentage lines are going to directly be drawn along how much capital comes from each individual source. Now, could you do that with a non-disqualified party if you wanted to have them come in and, let's say, float rehab costs, or you wanted to finance the whole deal and you wanted to get creative with that? Sure, you could. I mean, again, you have to have big level of trust if someone doesn't have skin in the game for it. I think that's kind of easy enough for anyone to kind of understand. If someone has zero money in it, making sure that they have a realistic expectation, invested interest in seeing it through.
That's how I did my first flip.
Yeah.
At a joint venture like that.
Awesome. Someone else raise your hand or no? Simply no. All right.
Another point is,
Yes.
if you do a joint venture like that, like with your spouse's IRA, you can't fix your own toilet.
Mhm.
You can't do it. You have to pay somebody else, and it has to come from whatever the percentage split is, 80-20, 50-50.
Yeah, if it
100,
were,
0, whatever.
yeah, it also depends. I mean, think about it in the context of how you structure the deal, right? If the IRA and everything has a tenant comment on the deed, yeah, you got to write multiple checks. If it's an LLC that holds it, it's all coming from one place anyway. It's all commingled, so you don't have to worry about necessarily doing the attribution on a more forensic level, because it just comes out and then it nets out when you do a distribution to the members, right? So, you pay that $1,000, it comes out of that commingled pool. Well, the only time it's going to be split up is just the member distribution or shareholder distribution. So, again, that's why people like LLCs and entities and trust for partnerships, because it makes things a lot simpler on the administration of the asset side. So, yeah. How are we doing, Marco?
We got 10 minutes.
All right. How much should we get? Lightning round. Okay. Question over here.
I was only gonna say you mentioned earlier for mortgages, so
Mhm.
people who lend.
Yeah.
And they want, to grow their IRA, their 401k, for shared equity. So either someone's receiving interest, 8-10% interest, or that shared equity where they could get a percentage of gross rents or a percentage of the profit. My understanding is when they do that, the person who has a retirement account, they can't go change toilets. They can't be actively involved in the project.
Yeah, it's a little bit more of a. I really think that's definitely more of the dark gray side, leaning towards what I would say is if it was.
Light gray, dark gray?
What I would say if it was
Is there 50 shades?
There's as many as you want to be. But no, if from my perspective it was me on that, I wouldn't do it. I like to be pretty aggressive with stuff. But again, if that was me and I was doing something where I lent someone money for it, and it was recorded and everything, because granted you can lend someone money with more of kind of a handshake unsecured note where you write it on there but you don't record it. I don't think you should do that. Because if things go south and you try to go to the clerk of court and be like, they didn't pay me, look, and be like, why wasn't it recorded? Well, Yeah, try explaining that to the clerk. But to that perspective, again, I wouldn't do it. I think you ask any subject matter expert or any attorney, they probably tell you not to do it. That's my take on it. It's not as clear. Even if you read 4975 in the Internal Revenue Code, again, it's very high level because that covers anything to do with IRAs. So they're covering, with that legislation, they're covering stocks, bonds, mutual funds, everything. So again, it's not as granular as we'd like it to be, especially with how diverse investing in real estate is. I mean, think about it tonight. We're talking about real estate, but I've been up here for like an hour and a half talking about all these different ways you can do real estate. So it's like, again, it's kind of tough to kind of drill that down. But okay, to that point, I won't do it. All right. Let me see. What do I want to end on tonight? Okay, pretty much covered like who can do repairs, paying expenses. Okay, let's cover a little bit about kind of again, high level of, let's say you have an IRA, like what's it look like functionally? Let's strip back and kind of look at the basics of this, right? I think it's kind of good to kind of, we've done this whole trip together, but let's kind of bring it down to, again, where the rubber meets the road on a very fundamental basis, right? The important thing to understand if your IRA is investing in something is going to be that the IRA owns it. IRAs are most analogous to trusts, right? So it's not you personally going out there, it's your IRA, it is on title to whatever it invests in, whether that's a trust that it's partnering in, whether that's a piece of real estate it's directly buying. And the IRA custodian is the one that has to sign those documents. So let's look at, again, let's use a case study of a piece of real estate, right? You got a piece of real estate you want to buy. You contact Advanta and say, hey, Advanta, this looks like a great deal, let's do it. Cool. The contract needs to be written in the name of the IRA. Advanta IRA, FBO, John Smith IRA. Great. You approve it, we sign it, we start going to closing. Deeds in the name of the IRA. Settlement statements in the name of the IRA. Again, Advanta IRA, FBO, John Smith IRA is what's the title purchaser of that asset. And again, you can extrapolate that to that's what the title lender on a loan is. That's what's going to be titled as the member of an LLC. That's what the beneficial interest of a trust is. It's all uniform, which is nice. So once you kind of understand the basics, you go forward from there. So again, deed, title policy, prorations, estoppels, all in the name of the IRA. We send that off to the closing attorney, the title agent. You basically, once we work all the documents out, we send you a doc pack for approval on DocuSign. You say, okay, it looks great. Or hey, they missed something on line 7 of the HUD. Okay, we got that corrected. And then at closing, we wire the funds to close. The property is recorded in the name of the IRA. And then all those kind of tools, or those rules and everything that we covered kind of start going into effect. You can't work on the property, all the cash flow comes in, all the expenses go out, and you continue to rinse, wash, and repeat. And again, that example and that kind of construct works for whatever you're investing in. So LLCs, trusts, all that kind of cool stuff we talked about. Same basic way that it works out, exactly the way, just with the name of the IRA. So let's look at something again, start to finish. So this case study is actually using your name, I guess. All right. So John has some of his old 401k from a previous employer he wants to use to purchase some rental property. What happens there? Okay, great. He wants to do it. So the first step, and this is kind of where I see a lot of people get into a little bit of a pickle, is that they go out and they find the property, like, yes, great for my IRA. They get it signed under contract in their personal name. We get a call, like, it's closing on a Friday, we get a call on Monday saying, look, we're buying this property in my IRA. And I go, what? You know, maybe. So the first thing to do if you want to start doing this through an IRA, get the account open, because the earlier we can be involved, the easier all this runs. And that doesn't matter if you want to be a wholesaler, it doesn't matter if you want to do options, tax deeds, straight line real estate, lending people money. The earlier we're involved, the easier everything's going to run, because we can get engaged, set the expectation, tell people what's going on. So in this case, John opens the account, he goes and then he goes and finds the property, or immediately once he finds the property, opens the account. We then in turn pull the funds over from the account that he's looking to move it over from, whether that's a 401k or an IRA, we walk through the process. And then once everything is provided to us, we have him approve it and then fund it at the end. So account's open, asset is acquired, we coordinate all the details about everything going through that, client approves it, we fund it. It's basically 5 steps. It's really not that complicated. Now in this case, against a piece of property. So what was the ultimate goal with that? This kind of really illustrates this. I need to update these numbers because if anyone has a deal that looks like this, I'll buy 5 of them. So he goes and purchases the property. for $150,000, right? So he rents the property for 2 years at $1,200 a month. So 28 grand after 2 years, right? And for easy math and everything, we're going to assume that this house is located in the wonderful world of Narnia. There's no taxes or insurance or anything else on that, right? So he has $28,000 of just straight line profit that comes into that account. No taxes being paid on it, right? That's just 2 years of owning one property in the IRA. After 2 years, he's like, you know what? I want to sell it. Makes $50,000 in profit, right? So over 2 years, he has gone from having bought it for 120. Bought it for 120, did the rental, 28 grand of net profits on just the income of the property, 50 at sale. So now he made 78 grand in 2 years. And this isn't a crazy exotic deal of saying, oh, he did all this great stuff. He just bought a rental property, rented it for 2 years, and then sold it for a profit. So now no taxes are paid on any of that 78 grand that came back into the IRA. So now from there, he started with 120 2 years ago. Now he has 198 to then go and turn and invest. Remember, didn't have to hold back any for taxes to have an estimated tax payment, didn't have to do a 1031 exchange, didn't have to get creative and exotic with anything. You just bought a property, rented it, sold it, turned around and did it again. It really can be that simple, and the numbers really start to add up. And again, you can do that with lending people money. You can do that with oil and gas leases. You can do it with mineral rights. You can do it with wholesaling. You can do it with options. You can do it with all sorts of cool stuff. None of the income is subject to taxes at that time. Granted, Roth versus traditional, plus all these have differences in the end, but the meat, the middle of all of these is exactly the same kind of taxation, which is, there we go. I had to end it with at least one more shout out. So, you could probably, you want to get real complicated, let's go.
Just let them know it exists.
So, what he asked about was a specific kind of taxes called unrelated, well, there's two. So, there's unrelated business income tax, which is kind of the misnomer that people kind of point out. They say, oh, well, what about this might trigger this tax? Where this is going, and that really only applies if you're buying a business, right? So what the IRS does with this tax, they say, you can't buy a laundromat with your IRA and just have a tax shelter own something that makes revenue. Otherwise, it's just kind of a feedback loop with them never getting paid. They don't like that. So what the more specific one that really is at the crux of this is what's called UDFI, or Unrelated Debt Finance Income Tax. So in this scenario, this only is going to really apply if you are going out there, you are going to borrow money, if the IRA is going to borrow money, right? So if you're putting a deal together and it's all cash, or you're lending someone money, don't have to worry about it. It's basically a leveling the playing field tax. So if your IRA goes out and borrows money for a deal, in that same example that I was just with John's property, if he had to borrow any money to pay that $120 for that property, then there would potentially be a tax on the revenues, a portion of the revenues that come into that IRA. Long story short, the nice thing is that you do get to take advantage of depreciation, amortization, expenses to help reduce that figure, and you also get a $1,000 automatic deduction from the IRS. So again, it's just on the income as it relates to the average underlying loan value over 12 months. But again, if you're going to be borrowing money with the IRA, and that's why most people do these as cash deals where they lend people money, you do have a potential to expose an IRA, a portion of the income that the IRA receives to taxes.
I do creative joint ventures.
Again, that's why joint venturing is so powerful, and to the point again of financial friends, you can make a deal work cash. It's going to make your life a lot easier. So cash deals, and don't deal with your immediate family. Again, now we're getting to 95% of the problems that you're going to cause with an IRA can be absolved by doing those two simple steps.
So
yes.
you pay the taxes, or the IRA would pay the taxes?
IRA files tax return. It's 990-T. But you got to follow. I teach a whole 2-hour class on understanding UBIT and UDFI taxes and how to avoid them. Also, if you do want to debt finance real estate, here's kind of the big nugget I'll leave you with, is that 401ks are exempted from that tax. You don't have to file anything special, but if you are an individual business owner, you sell widgets on eBay, you can qualify for that 401k plan. You don't have to pay that tax. So you can debt finance real estate to your heart's content and pay 0 in additional taxes. So that's pretty cool. So 401ks, again, another reason why I really like them.
Can you do You didn't talk about it, but can you do checkbook control with HSA?
Yeah.
And Advanta allows for that?
Yep. All right, question.
So if I was paying attention, which I think I really was, what I heard you say all night was, get a divorce?
Get a divorce.
Out of all,
Did I hear that right?
out of all the amendments, I can pick one. And I believe that.
And you can borrow from her 401k.
Exactly. She heard it too.
No, you not divorced, quit your job.
And where you got
I disclaim any liability from actions taken or not taken. So that's what I got for you. I want to really appreciate John for inviting me out here. It's a pleasure. I always love getting in front of new people. Hopefully it was some new and good information for y'all to make some informed decisions. And if you don't want to make decisions, I appreciate you guys.
Great job.